Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. We are coming live from Silicon Valley. You can ask questions as we're having the show here. We'd love to try to answer some of those. You can do that in two different ways. Number one is, send in the email here, ask Tom at talkmoneywithtom.com, or you can put it right into the chat on the channel here on Google if you're signed in. So uh, really, the whole concept of this show is to try to help people, get someplace in their retirement financially, and we do that by answering your questions. So you can send them in during the week for next week if you want to also, as far as that goes. But of course, we do have this channel. There's a lot of resources on here. Feel free to browse the thousands of videos that we have on here at the moment. And we will, you can subscribe, you can hit the little bell to get notified when we put new content, because we're constantly, updating things. And then, of course, if you just want to meet with Ethan and I, you can do that. We offer a free 30-minute consultation, whether you're a client or not, happy to help out. And so you can do that by going to the book appointment button that's on our website. Link for the website's here on the channel. Button looks just like that. It's up in the corner. And you pick a time and a place, phone, video, in office, whatever that might be, and we can, talk to you individually. All right, so we do like to start off the show talking about the market. There's been a lot to talk about for quite a while. It's kind of incredible. Today is a red shirt day. So for those of you who don't follow the channel, on a regular basis, I do daily videos. I did miss a bunch of them this week. We had some technical issues that kind of got in the way. However, I wear different colored shirts depending on what happened that day. Green means it's up 1.5% or more, and red means it's down 1.5% or more, and there's a bunch of different variations. But so today the market's down a little bit over 1.5%. Now the week started off really strong. Right? Monday was up a little over 1%. Tuesday was up another 0.25%. And so, it looked like, okay, we're getting somewhere. Oil was softening, in terms of demand. But then the Federal Reserve meeting on Wednesday, that's when things really got kicked off to the downside. And we went down Wednesday, Thursday, down today. And whatever dip buying had been coming in and kind of saving us came in a little, but it seems to be lessening as time goes on here. And so on Wednesday, when the Federal Reserve Chairman Powell came to, the question and answer session and what have you, he was pretty hawkish. And what that means is that, they were talking about less chance of lowering rates, which is where the market was, and criticizing the tariffs and the price of oil situation that has been put into place by this administration that creates an inflationary, environment where we already have some inflation as it is. So that's the big concern. So if we take a look at kind of what's going on, we've been looking at this chart for quite a while. Mm-hmm. This goes back to the end of 2018, and all the way through. It's just extending to the downside. And actually, what's really concerning is where we're at right this minute. And so this is just looking at the last year. That was, weekly data. Now we're looking at daily data here for the last 12 months. And we've been talking about this for all the way through. This was a flag pattern, which is usually a good pattern on extenuating, whatever trend was there should keep going. And again, what's happening is we just keep throwing new things in front of it. We take the tariffs away, at least partially for, the Supreme Court's ruling, and we put back new tariffs on. We go after Venezuela. The market drops a couple percent, comes back pretty quick. But, it's just constant. But this Iran situation is probably the most concerning, and we'll talk about why. But right at the moment, we're just below kind of where we were back in November, in that low point. And we'll see where the market closes. Right, that just matters. But normally you would still get some type of a bounce off of here, because there is some, buying opportunity that comes in on these types of points where, that market reversed at that point back in November because enough buying came in, and those people looked at it, hey, we made money when we bought at that point before, it's back there again, and so they tend to have some support. Now, So that'll be very interesting to see what happens in the first part of next week. Do we have some type of a bounce? Because then you're just touching the bottom of the channel. That's not a big deal, to be honest, versus breaking out of that channel and continuing to the downside. One of the problems with this, if you look closely at this pattern, we went up fairly quickly, which always sounds good, except when you start to retrace back down through that, because that just means that we didn't spend much time at a lot of these different prices. And so there isn't a lot of support at those prices. There aren't people that are saying, wow, I bought back in, May or June of last year or whatever at this level, and boy, I was made money for a while, and it's back there now. I'm going to buy again. There just aren't as many people in that price range, and so that's where, that's where we are now becomes more concerning, just because of the fact that, there's more overhead resistance now because we spent a lot of time at the price above us, and less under support as far as that goes. And so, and of course, this is being caused by the situation in Iran. So I have S&P 500 here. This is just hourly data. This goes back to roughly the November timeframe. So the S&P is in the green, and then oil is in the black, right? And you can see very clearly that as oil started to really accelerate after the excursion in Iran, we've seen the stock market continue to come down and come down. And so what's going on here is very fascinating. The Iranians are not even willing to talk about opening the Strait of Hormuz. I've been learning more and more about that. These are big targets that move really slow through very shallow water that is very narrow. And so they're like really easy to hit with drones.
Sitting duck, basically.
Yes. And so even the militaries don't want to go through there because they look at it as kind of like a kill zone, as far as that goes. And Iran is making these inexpensive drones and missiles, hundreds a day, essentially. And so that's going to be really hard to stop because the shipping companies have to decide they want to go through, okay? And Iran has let some through. And matter of fact, that's what was happening on Monday when the rallies was happening. There was some news over the weekend that some of the ships had been allowed through. Probably Iran still needs the money. Maybe they let some of their ships out, which again is still supply of oil on the market, which is an important thing and could moderate price. And so that's why the market was going up. However, since then, we've had two major liquid natural gas facilities bombed, one in Iran and one in Qatar. And so, here's the key thing. Iran is trying to have a regime change here in the U.S. So the U.S. trying to cause a regime change in Iran by killing the Ayatollah. What Iran's trying to do here is to get oil up into the $200 barrel oil area and keep it up there as long as possible, to squeeze the economy, the stock markets and bond markets, so that maybe there's a regime change here in the U.S. Okay, so obviously that would start with something happening in the,
Congress.
Probably the way this Congress is structured, it would probably be the midterms, and then maybe something happens. So who knows? I would say it's going to be difficult. You're not going to see a scenario, in my opinion, where Trump is just removed from office because of what's happening here. But what will happen is that there's we're kind of in a box, and the whole market. If you go back to what happened, Liberation Day was one of the craziest things I've ever seen. These massive tariffs, every country, including little islands with penguins, and the markets dropped 20% like right away. And then within just a couple of days, they backed off and said, no, we're not going to do these until for 90 days or 30 days or, dependent on the country. And the market jumped back up. And ever since then, the market's been going up based on the thought process that even though the things that keep being announced, higher tariffs or whatever, are there where the market should be reacting negatively, it wasn't, because the feeling was, can always change his mind.
Yeah, and the thing with tariffs is you can just do it as a swipe of a pen, basically.
Yep.
It's so quick. It's it's a unilateral decision.
Yeah, and something that Trump actually controls. And so the expectation is that Trump will chicken out on even on his tariffs or deportation or whatever is happening out there that was maybe be causing, major economic problems. Trump can always back off. He can chicken out. This particular situation in Iran doesn't have that capability because we walk away from the bombing and what have you that we're doing. There's no guarantee that Iran's going to open up this thing. So now today's news is about ground troops and plans for possible ground troops. And of course, that's what's making the market go down also because you're talking about, so if that's the solution, is to try to somehow make it so they can't launch these, missiles and drones into the Strait of Hormuz, whoa, that's a long time from now. Yeah.
That's expensive, and it's going to be
Uh,
life-wise and just cost-wise.
and it won't be popular whatsoever. So it's going to really, be interesting to see how this ends up playing out. So as we announced, last week, we have been, we reduced our exposure to the stock market further. And so right now in our models, we're either, we're about 48% T-bills, like in our 100% stock model and our IRA type accounts, our traditional model. Some of the other ones we still have some gold and silver and some of our taxable accounts, even though they're not doing that well. We still have big gains there. So we're looking at what to do with those pieces because the gain, unfortunately, is a short-term gain. We hold on to it long enough and the market falls farther, we won't have a gain. So, do we pass along, gains to the clients that are going to be, pretty heavily taxed because of its ordinary income instead of capital gains tax? Mm-hmm. Or do we, try to hold in there and see how it goes? And we bought them in October, so we got a ways to go before we'd get to a spot where we'd have a long-term capital gain. But the rest of our, exposure is what we call our core pieces, and that we're down to 49% stock market exposure in total. We were at 65% before Liberation Day. And so we'll continue to ratchet that down if we need to, just based on what's going on here. I think one of the things that has to play out, and it could take a while, is how do we do with a higher oil price, right? Because the big fear was, the tariffs are going to wipe out the economy. That's not true. It didn't work out to be true. And mainly because the economy is so strong, it can handle that headwind, right? Can this economy, which is still pretty strong, you've got some reports coming out about the AI build out and what have you this week, can it handle $100, $150, even $200 a barrel oil? One thing that is different, because what happened in the 70s was that the Middle East had an embargo and they basically wouldn't ship oil to the U.S. because of the Yom Kippur War and the support that we were giving Israel there, and oil went from $4 to $40 a barrel in a 7-year period. We had restrictions, even in odd license plates, and a lot of us, that were around at that time definitely remember that. But we're 70% less reliant upon oil now than we were back in the 70s. Mm-hmm. And that's because, number one, we're not using as much. The mileage standards on cars are way up, right? There's electric vehicles that are out there, and alternate sources of energy outside of oil. And I think the other thing that's interesting here is just that, the U.S. does produce its own oil at an excess. We actually are net exporters, mainly because of the fracking technology allowed us to become, an importer and become an exporter after the fracking technology becomes, used. And so that's what's going on altogether. It's a really fascinating time frame. And so now the Federal Reserve gets out there and starts talking, and one of the reasons the market is coming down also is because there's been an expectation for 2 rate cuts, mm-hmm. right? Now, one in June and one sometime after June, depending on what chart you were looking at. And that expectation has disappeared.
Yeah, it switched to actually a rate increase.
Yeah, and so this is a little hard to see this, but just bear with us. So this big blue bar here that's at 84.1% is the expectation in June for what the rate would be. And so it's the same rate we're at now. So essentially, there's now an 84% chance that the rate does not change. Even just a month ago, that was over a 50% change, chance that it would change.
Yeah.
And then the other part of this, the bars are on the other side, right? It was still, okay, hey, we were at X percent, we're going to stay, but then all of the other bets were still something lower. Now it's higher, right? So there's a 15.4% chance, according, in the markets, futures market here, that the rates go up by a quarter point in June. So, that's a pretty small percentage, but it's a big difference from where it was before. There was no expectation for rate increases. And if you go through month after month and look at what the bets are, revolving around these Fed meetings, you still get, a flip from expectations for cuts to expectations for possible rate increases. And so again, that's what the market's responding to here. I don't. This situation in Iran has put us in a box, and Iran has been game planning this out for a long time. We obviously are totally unprepared for dealing with the Strait of Hormuz, and we had minesweepers there for decades to try to deal with this problem if it ever came. In October, we brought those minesweepers home. They're shipping in, Marines. Well, they're still 2 weeks away. I mean, these types of things and these levels of pricing can have damage on the economy. And again, we could get to a spot where we realize, hey, we're doing okay at $130 a barrel, and the market would come back around, right? So that's something to keep in mind. Just because the price of oil goes up does not mean that you're going to have a calamity on the economic basis, which would create that calamity in the economy itself. In the stock market. So, however, the probability just starts to grow, right? And that's what, to me, investing is about probabilities. So the probability of downturns or problems with the economy or situations that can affect the stock market negatively has gone up, no doubt about it. And so it just, you keep putting these headwinds in front of what is a fairly strong economy. Is the headwind finally too much?
Yeah, are you going to stall stall the economy? And that's
Yeah.
what people all fear is because of the stagflation,
Yep.
rising inflation, but the economy's still growing, but very slowly.
Very slowly, yeah. And so, and what what's out there is private credit, right? So this is the big thing. If you kind of stall the economy enough, sometimes it just creates things failing, right? That might have made it if the economy kept going well, but they're not, because the economy slows down just enough, and then all of a sudden that creates a cascade of farther. So private credit is this loans that have been made by these private credit companies outside the banking system, at least, especially initially. A lot of them are they're not regulated, so a lot of these loans potentially are lower quality, right? And so companies that that are living off their debt, actually they have to actually put out new debt in order to pay for the existing debt that they have, and or bills from negative cash flow. And so that and now we're starting to see that there's a connection between private credit and the actual banking system, because some of these big banks have lent money to private credit companies who then have kind of gone around the regulations and lent money to these other companies, right? So anyway, there's a lot of that money sloshing around. Unfortunately, we can't tell exactly how much, because it is literally a private transaction. So anyway, that's the piece that's out there that is sort of weighing on the market. Also, is just so you're going to see the market adjust itself downward to a point where the perception of risk kind of equals the perception of where the market is, right? So the perception of risk has grown since Iran, because it's now a headwind that we can't chicken out on. Yeah. And markets are like, whoa, okay, we just stepped in it, right? And how are we going to get out of this? And so that's kind of where it's at. So again, things could change very quickly. There's things, it's difficult for me to see how we can chicken out on this, but there probably is some way to do it, and some negotiations that can happen. The problem is, right at the moment, as we're speaking, and literally, I mean, this today, Trump is talking about how, well, there's nobody to talk to, to negotiate with, and that's kind of how we like it. I'm like, well, wait a minute, He doesn't seem to realize the damage and the potential risk that's being taken by having these higher oil prices. People are making money, the oil companies are making money, and they're
Yeah,
probably happy with him for that. But
there's a pretty common saying with commodities is that to solve high commodity prices is high prices, because eventually enough people will come on the market. If there is a demand, people will fill it. But the issue is you can't solve that overnight, so it's going to take months.
yeah, exactly. And there'd be all kinds of consumer behavior shifts.
Yeah,
Electric
demand will
cars
be.
probably pick back up in demand. They've been falling off for a while.
Yeah,
You
there's
know,
there's
all
going to be a
these things.
demand destruction.
Yeah, yeah, exactly. So that, you know, people will use an electric bike instead of, for short commutes or whatever it might be, right? And so that's, and we already have less reliance. So again, we'll see what happens. The market could be overreacting to the oil price surge. We won't know for sure if this economy can handle that surge or not until later. And so you kind of wait it through. And so that's why we still have exposure to the market, because again, the probability of it going down further is not 100%. It could rally up next week for all we know. There's different. We certainly saw some of that this week on Monday and Tuesday, just based on some softening in the price of oil and such too. So anyway, we'll see how that plays out. All right, good. Thank you for joining us for our summary. Let's start off with the questions here. What do we have for questions?
So, what is a financial contagion? Should we be worried about private credit evolving into a financial contagion?
Yeah, contagion just means that, it can happen anywhere. You could have, China's real estate market completely implode and our stock market gets crushed, right? And so it's this, somebody catches a cold over here and then everybody else gets sick over here. So
Yeah, it's kind of like a domino. You
Yeah.
push one domino down here, and then you don't know where the last domino is going to fall.
And that is one of the key things, is to try to identify these dominoes that could fall. It's a lot harder than it sounds, because a lot of this stuff that's really risky, the 2008 downturn is a great example, because what happened there was, we're going along, we're all hearing about subprime loans, and how a lot of them are defaulting because they were lending money to anybody. And they were packaging up these loans into bonds and reselling them worldwide, which gave them money back, which then they'd go out and find somebody else to lend to, right? And so you could get a loan for a house no matter what your income was at one point in time. So that's bad enough as it is, because that's going to create some problems. But the real problem was this private market called a credit default swap, which was an insurance policy that was placed on top of that bond. So if that bond, which was rated AAA, by the way, if that bond defaults, they will pay off on that bond. Well, of course, tons of those defaulted because a lot of the real estate, was totally unsupportable. And the people's ability to pay negatively amortized loans. The issue was that, at the time, even the Federal Reserve and the Treasury did not understand the size. Within 5 years, $7 trillion worth of credit default swaps were issued.
Yeah.
And so all of a sudden, these companies are having to pay off these loans. They're either going bankrupt or they were selling everything they had. All of your great stocks, all of the gold and silver, everything was being sold off. And so that's where the contagion is, right? So credit default swaps are out there. They didn't realize how big they were. Lehman Brothers was allowed to fail and kind of was the last card to knock that whole thing out. So if you look at where we're at today, Jamie Dimon, the CEO of Chase, is running around talking about, the possibility of contagion and issues with private credit. We still don't know for sure how big it is.
I think there's speculation of 3 or 4 trillion.
3 or 4 trillion, yeah, which is big enough to create some serious problems. And so it's the same type of thing. You've got loans that are outstanding. If those loans start to become worth zero, somebody is selling other assets in order to cover that. And apparently the biggest contagion point seems to be that now these major banks have been lending money to the private credit companies themselves, who then go out and lend it to these, unregulated, in this case, loans through, to these other companies, some of which might be, higher credit risk.
Yeah, and we've seen some sort of redemptions being paused or stuff like that, where
Yep.
most most of these closed-end funds, they have a policy where you only allow a percentage of redemptions per period.
Right.
So they can kind of close that. Because it prevents, with these private credit, it's a very illiquid
Yep.
asset.
Yeah, the money's out in the loan to some company. They can't just go get it back because you want your money back. So that's actually a really fascinating point, because if you think about it, what's happened there is that we're protecting from a run on the bank problem,
Yeah.
right? We don't have that in this scenario because these companies are allowed to basically close their withdrawals or limit their withdrawals. Whereas, you really can't do that at the bank. They don't have, when you put money in the bank, you expect to be able to go get it out. And the reality is you actually can't. You can't all go get it out because even the bank has money out in loans and such too. So you don't have that. But what you do have is default risk, right? So if these companies that have these loans can't pay it back, that goes all the way through. So yeah, we can't do a run on the bank and crush the private credit companies and bring the economy down that way. But as the economy slows down with all of these headwinds, you're going to get possibly more and more of these private credit loans defaulting. And then that becomes an issue for the bigger banks, right? Because those private credit companies were borrowing money from the bigger banks. Most of the money did not come from the bigger banks. Matter of fact, they weren't really that involved at the very beginning. It's just private money. This is something, if you want to do a leverage buyout, like a company, and you want $7 billion to buy this company out, the private equity companies, this is where that money comes from. It's from this private credit area. And anyway, so it is actually a really important component. The question I have is, thinking back to 2008, we weren't talking about credit default swaps. Very little, right? And they weren't talking. I watched actually all of the things that happened around Lehman, and if they would have known about the credit default swap market, they probably would have bailed Lehman out, because it ended up costing the U.S. a lot more money in the end than it would have cost. It was a $150 billion bailout, and we ended up spending $7 trillion. Okay. Now, maybe that happens anyway, but I think if we could go back in time. So what is it that's out there besides private credit even? Because we were all talking about subprime loans, right? We knew about those. I look at my portfolio, no subprime loans. Still, the stock market dropped 57%, right? Yep. Good stocks, things that were doing great. Companies, turned out to be buying opportunities, but that's a long ways down before it gets there. So that's the type of thing I'm always thinking about is, what are we not talking about? And again, the reason being because from a psychological standpoint, if everybody's talking about private credit and how they're going to have a problem, and then it does have a problem, it's never going to have the same impact as something that's a total surprise.
Yeah, people can hedge for expected
Right.
risks. And so I assume the banks are starting to go out and hedge against these risks and find ways to protect themselves.
Right, exactly. So, what's out there? Are there, and again, these types of situations are private, so there's no reporting requirements, those types of things as far as that goes. So, usually it's having something to do with leverage in today's world, at loans and what have you, and it's not publicly known numbers, so we can really see what's going on. How are these private credit loans really performing? For all we know, they could be okay or they could be awful. You can have a lot of zombie companies.
I think that's very common towards the end of this economic cycle too, is where money starts to go into more speculative and more riskier events, trying to hunt for returns. Because there's only so many quality opportunities out there, and so as you fill each bar, eventually you have to go to less and less quality. Yeah,
that's exactly right. And so the farther we get down the road, the farther we go into, poor quality loans. You're exactly right. I mean, it's exactly what happened in 2008. Ran out of good people to lend money to for their homes and ended up just giving it to anybody, because it was free money coming back in from the sale of these bonds. So, that's we're kind of building this thing, and we're adding. We got pieces of 2022 in here with the inflation potential now with this oil part. we have oil embargo type scenarios like we had in the 1973, and we have loans and other pieces that's a little bit like 2008. We're like making up our own little downturn here, potentially. So, and at the same time, we have essentially a dot-com economy like we did in 2000, where things were roaring, and we have this AI piece that's making things really roar on one side, right? Is that enough to overcome? And unfortunately, we keep adding more and more roadblocks. And it just, trying to distract from the Epstein files is causing, oil to go up to $100 a barrel. And so, and we're already talking about Cuba, which seems really crazy since we haven't remotely solved the Strait of Hormuz problem. But, we'll see how that plays out. Okay, what's our next question?
What would be a good previous a historical event to compare to current events? You just mentioned, we're taking little aspects of each of these different downturns or bubbles and kind of combining it into one big bubble, you could say, but what opportunities do you see to take advantage of this?
Yeah, I do think it's very fascinating, right? I mean, you've got sort of an oil embargo, at least from Iran's standpoint, by blocking the Strait of Hormuz, like we had in '73. We have this situation with potentially higher, inflation. We're already at 3%. Expectations are that might be growing, right? So that's kind of what we had in our 2022 downturn. And then we've got private credit and some of these high leverage things that are out there that are potentially unknown that could create bigger cracks that will happen in 2008. And so if you look at all of those downturns, okay, so it was 45% in 1973 down, 57% in 2008, and 28% in 2020, right? So those are the numbers. So what's the opportunity? Right now we're down 5%?
I think we're
6?
pushing 6 something now with the current drawdown.
Okay, so is that the opportunity if we're going to end up in anywhere near some of those other areas? So that's where it's very difficult to tell. Is there a percentage drawdown where you start to buy? So there's really only a couple ways that I can see where you take advantage of this. You just continue to kind of nibble in, right? And especially, things that are really doing really well that all of a sudden become cheaper. And so you don't want to buy in completely, in my opinion, just because if it's down 6 and it goes down 56, you're going to get hammered, right? So you keep just kind of buying in as it comes down, as you get opportunities. I would especially look for situations where the relative strength index, RSI, was stretched to the downside, whether that's the market itself or the individual security that you're looking at that you believe in, whether that's an individual stock or a category. There's an obvious play here in the energy arena, but the problem with energy is so fickle. You can change and solve. Iran could open the Strait of Hormuz and you would get killed in your energy ETF.
And if you're probably something like that, you could probably look to do it in your IRAs where you have no taxable gains or something like that.
Yep.
That way you are able to move in and out quickly because it could be a short-term trade.
Right. Yeah, but that's what I'd be watching for. I would have a list of things that I'm really interested in, whether it's the full market, parts of the market, individual securities, whatever it is.
Yeah. What kind of thing that you have conviction in, saying, hey, if this got down to a certain price, I think it's cheap and it's you're buying something of quality that you believe in you could hold for 5-10 years.
Combine that, though, with an RSI that's below 30, and you're probably going to get a bounce back right away. And so, you go in and buy stuff at RSI 30 or less on that list. And, so I probably would use that more than a price, just because we see it all the time. There's a fear thing and this panic comes in. And even though, it might only be down 10% and it ends up down 40, that was still a pretty good buy. If it does bounce back, you got a good spot. And so you just keep looking for those all the way down. And, then when things do bounce and things do come back around, the problem is, what do you buy with? Do you have current cash flow coming in because you're employed or what have you? Okay, good. Then you have something to use. If you're fully invested right now in the stock market, 100%, what do you use to kind of do? And so if you're in that position, what you're doing is you're wanting to shift slowly but surely into some of those high quality things that have a higher beta than the market itself. So, for example, during the pandemic, everything was falling so quickly. On March 5th, we ended up moving some of the money, which we hardly ever do individual stocks, but we moved money into Apple and Microsoft. Just because, again, these are high quality pieces with companies with very low debt, huge cash flows, huge cash positions for that matter. They were falling less than the stock market as a whole, but they have a higher beta, which just means they move more versus the market one way or another. And so when the market does come back around, you can then get back quicker, if that makes sense. So that's what happened to us in 2020. We were fully invested in terms of, what the clients wanted us to be invested, and really didn't have any way of responding, to get out of the market. That was a fast downturn that happened basically overnight. And so we rotated on the beta basis. So there's opportunity there, but like we are now, we have a ton of money in T-bills. And we've had that for quite some time. We've added to that recently. That'll give us a chance. So for me personally, I'm looking for those bigger stretch points where we might go in and say, okay, add to our S&P 500 holding or whatever it might be, right? Dollar cost averaging in, and as far as that goes. So that's, the best way to dollar cost average, in my opinion, is to have a set model, percentages that you have. So let's say you have, 20% in something, and it drops down to 18% or whatever, you just rebalance and bring that back up to 20. As long as everything in your model is worth buying and holding for the long term, like the S&P 500 would be, you just keep rebalancing. And what I normally use as a rebalancing trigger is when the S&P 500 gets to be 30 or less on the RSI. I've had really good success with that. You rebalance. You go in a rebalance. And what's happening is, like, for example, let's say I have 48% T-bills and 52% S&P 500, just to make something up. And on my S&P 500, drops down to 48%. I'm rebalancing. I'm selling some of those T-bills and buying at that stretch down point. And so there's opportunity there all the way through. Now, again, the problem is, it depends on your situation as to how long you are willing to wait for things to come back around. And if you can't wait that long, then you kind of have to really reduce your exposure and just, wait for some true recovery to come in. And so anyway, it's a great subject. There's a lot of different strategies that you can use. It does depend somewhat on what the market's doing. However, right here, we're just breaking through the bottom of that thing, possibly. And we'll see really early next week whether that's true or not. I don't see opportunity right here.
Yeah, you could see if it breaks through, and you could see an acceleration down.
Yep. Right.
You could also see a bounce, but I feel for a bounce, you would need some sort of shift in like some sort of news event or catalyst upward. Because you remember, you're trying to catch a falling knife in a sense, right?
Yes.
And where you grab that, you don't know if you're grabbing the handle, the blade, or has the knife already hit the ground,
Yeah, if the S&P 500 went below 30 on the RSI in this free fall downturn as we fall out of this, I'll probably rebalance into that, as far as that goes. So, we'll see how it plays out. But, our strategy as a firm is a little different than most. We specialize in retirement, and we have a lot of people taking money out of their accounts, to live off of. And so protecting principal is really one of the key things. It's not the key thing, because if it's protecting principal, we might as well just be a bank, right?
Yeah.
Or the key thing is to keep up with inflation long term by having exposure to the stock market and trying to have that so that clients can have a standard of living that they really want. And so, but within that, you can't let all of that money get wiped out in the market. So that's where we find these, we make these changes. I think we're probably different than a lot of firms. We have a lot more T-bill, formerly stock market exposure pieces that are in T-bills now. But that's because, the probability of downturn has grown to a point where, it's a good idea to get a little conservative, and then we'll have something to buy with. We could do quite well if things do fall, and a recovery comes at a quick enough period. But
yeah, if you're saving money already, like let's say you're contributing to 401k, I would just keep doing that. I wouldn't change your existing habits.
Right.
But if you could save some extra money some elsewhere, you could use that as kind of like an investment opportunity.
Yeah, 401ks do really, really well over the long term because of that dollar cost averaging. You're putting it in every paycheck, some money's going in, it's a great area to have, and that actually is a big piece of what drives the market as a whole. There's a ton of money that comes in from 401k contributions. And it's one of the reasons why the market is doing so much better. So if you think back to the 73 downturn, one of the things that wasn't, there were a lot more pensions back then, right? Pensions are now pretty much gone, and they've been replaced by 401ks. Well, pensions had 20% exposure to stock market. 401ks average 80% exposure to stock market. And so there's new cash flow that used to be going into pensions is now going into, into the stock market through 401ks. And it is one of the things that just drives and drives because it doesn't care. Eventually you get a big enough downturn, people start adjusting their 401ks and, there's some things that can happen there, but they do tend to be a little bit more static, partly because they do better with dollar cost averaging. So anyway. All right, do we have time for one more?
So, should I change any of my lifestyle with the current oil crisis? Should I adjust my discretionary spending? Should I, I'm possibly planning a trip. Should I postpone that trip? Maybe. What changes should I make?
Well, I guess I would look at it kind of how we're looking at the portfolio, right? We had 65% stock and we're down to 49% stock. So we made a change based on the possible outcomes that we're seeing getting a little bit worse. So it's not a massive change. It's a lot of money, but it's not a massive change. So I'd be kind of in the same category lifestyle-wise. Maybe you do cut back a little, 5, 10, 15%, just because you want to gather a little bit more capital or what have you in case things, go sideways. Because again, it's the same thing as investing. Spending and investing are not that different. I mean, you're either saving it or spending it. So if you're going to adjust your lifestyle, that means you're not spending it. It possibly means you're saving something. Depends on where your revenue versus expenses. But yeah, I would do a little, just because again, the probability of problems here economically and ultimately into the stock market and earnings and what have you has grown, not massively, but enough so that there should be some, and the oil is just a piece of that.
Yeah.
It's probably the most important piece right now, but still just a piece. Sorry.
Yeah, I think if you have it budgeted already, I don't think you should make any major changes. You could say, hey, maybe we take a trip a little closer to home. Maybe we won't do international, do domestic. You could do a small shift like that. I don't think we're only 2 weeks into this conflict. It's very early on. I don't think you want to make any kind of major shifts just based on this.
Yeah, I meet with the clients all the time when we talk about these particular subjects, and I'm a big proponent of really identify what it is that makes your lifestyle, right? So there's this what we call the base amount, right? You got to pay these because they're mortgage, they're property insurance, their food, medical care, whatever. Okay, so that's pretty much non-negotiable. Some of that can be, do I go out to eat? Do I make my food at home? So there's some things. But if your key joy is going out to eat, then try to keep that in the budget and knock something else off that's not as big of a joy. It's one of the reasons why we work on taxes all the time, because you take away some tax, cost, then, that doesn't impact something that you really like. So if your real joy is traveling, try to keep that there and make up for it somewhere else. There's all kinds of places where things can be cut. And some of those aren't as important to you. If travel's sort of I have no problems changing from international to domestic, then do it. But for those things where, especially in this environment where we're just getting started on this, and we don't know that it's going to be that bad, really focus on stuff that's not as important to you at this point. And if you're going to look for things to cut,
it could be as simple as just reevaluating your budget. What subscriptions you have out there. Hey, You know, I
Yep.
have an HBO subscription. I haven't been using HBO
Right.
for the last 2 months.
Right.
Maybe it's time I cancel that. You know, you can do small things like that where you just reevaluate your budget. Say, hey, where's this extra fat that I'm not really needing or using?
Yeah, that's probably the bet right now. Just go through your budget, find that stuff you're not using anymore. I know every time I do it, I find something.
Yeah, you'll have like 2 or 3 subscriptions
right.
that you signed up for a long time ago, and
Right.
you're like, I'm not using this. I'm not getting any value from it. I need to cancel it.
I would use this situation as an excuse to go after that because, right, you're not affecting your lifestyle at all. You're tightening things up a little bit. You know, eventually you might have to choose things that affect your. I remember in 2008, you know, nobody was doing anything. I ended up having to try to buy out my lease in my car and was in the dealership for 6 hours and not a single person showed up to buy a car at a Capital Honda, which is a really, active dealership. And so that's where people had cut back, so that happens in those scenarios. We're not anywhere close to that yet. So now you start off at the top and just reevaluate your budget, right? And just see what you have that you can get rid of that won't have any impact on you for all intents and purposes. And almost everybody I know seems to have something like that.
Yeah.
Yeah. Okay, good. Great show today. Thank you for these questions and joining us today. Really looking forward to next Friday also. Again, send in questions. That's where these come from. And, our meetings with our clients and things that they ask us. So ask Tom, talkmoneywithtom.com. And then, of course, you can, subscribe to our channel if you'd like, hit the bell button. And get notified when new content comes out so you can kind of keep up with that. And then lastly, of course, is just, if you want to meet with Ethan and I, you can do that too. And we can discuss some of these things that are happening. And kind of philosophy-wise, what might help you, whatever that might be, as far as that goes. Okay, looking forward to seeing you again next Friday, and thank you for joining us today.